Don't want to miss out on skyrocketing gains anymore? Here's a tip to master investing in soaring stocks. Hello everyone, this is Michael's Fortune Bread, your guide to the US stock market. Recently, the market has seen a sudden surge in many stocks. Tesla has soared 60% in a month, Bitcoin-related stock MacroStrategy has doubled in a month, AI stock Aploven has doubled in a month, and big data analytics company Palantir has tripled in 6 months. Faced with these skyrocketing stocks, investors have had different experiences. Those who held these skyrocketing stocks undoubtedly enjoyed it, but also hesitated whether to cash in their gains as the stock soared. Those who didn't hold these skyrocketing stocks watched them rise daily, struggling with whether to buy and risk buying at a high or not buying and missing out on gains. So how should we invest in these skyrocketing stocks? I'm not one to trade recklessly. My analysis and trading always aim for peace of mind. In today's video, I will introduce a method for safely investing in skyrocketing stocks. This method includes a professional investment philosophy and practical trading strategies, covering both stocks and options. I will also show you a real trade of mine as a case study. This episode is very hardcore, so make sure to watch till the end. Before introducing the trading method, we need to clarify the trading scenario. When we talk about investing in skyrocketing stocks, what kind of stocks are we referring to? Our purpose here is to invest in companies, not purely speculate on stocks. If you're looking to trade meme stocks like GME, AMC or penny stocks, which also have the potential to skyrocket, they are not within our discussion today. The skyrocketing stocks we aim to trade are those fundamentally strong companies with long-term investment potential and whose stock prices have started to surge for some reason. Recently, Tesla is a typical example of such a stock. If you have a stock in mind that fits this description, congratulations. The method I will introduce may be helpful to you. This method for investing in skyrocketing stocks involves several key steps, each essential and sequential. When you get a skyrocketing stock, what's the first step? Many people first wonder how much more the company can rise. However, the most crucial aspect of opening a position in a skyrocketing stock is not evaluating the potential gains. These stocks already have significant gain potential. The primary consideration should be risk. Regardless of how much you believe in the company, you must understand that such skyrocketing gains are unlikely to sustain and could lead to substantial losses. This is a fate all skyrocketing stocks cannot escape. Therefore, in the face of these skyrocketing stocks, we must acknowledge that no matter how exciting the prospects and how much you believe in the company, as an investor, you must be prepared for the possibility that the stock could crash and never recover. This readiness translates into investment operations, requiring you to ask yourself one critical question before buying. What is the maximum price you are willing to pay for this stock? This question determines your maximum position size. For example, if a company crashing means it drops by 50% and you're willing to risk a maximum of $5,000, your highest position would be $10,000. After determining your maximum position, the second step is to choose an investment strategy based on the first principles of the stock market. One unchanging fact in the stock market is that no company can stay overvalued forever. Valuation reversion will always occur, especially applicable to early-stage skyrocketing stocks. Throughout my investment career, I haven't seen any company avoid eventual valuation reversion. Tesla and Nvidia both experienced over 70% declines. The same applies to any current skyrocketing stock. Understanding this reinforces the importance of controlling your maximum position. It is not just a means to manage future downside risks, but also to keep enough capital to seize opportunities in potential valuation reversions. Holding these skyrocketing stocks involves various temptations, whether it's the temptation to chase the high or add to positions during brief pullbacks. If you can't resist and exceed your maximum position, the losses during valuation reversion will be unbearable. At this point, we've clarified the trading scenario. We're investing in a long-term promising stock rather than pure speculation. We've also identified the risks and determined the maximum position. Finally, we applied the first principles to put insurance on the maximum position. Now we can proceed with the actual trading, which is today's main focus. Let's first look back at Tesla's stock performance in 2020. You can see that once the stock price started to rise, it kept soaring without any significant pullbacks. If you were waiting for a pullback during this period, you would never have gotten the opportunity and would have missed Tesla's most aggressive gains. In this case, chasing the high was actually a better strategy. If you look at the stock performance of Lemonade in 2020, you'll see a similar initial surge without pullbacks. But once it started to pull back, it never recovered. If you chased the high at any point during this period, you would likely have faced significant losses. So, how can we know which type of skyrocketing stock we are investing in? And even if we pick the first type, how can we know if we're investing at the base of the mountain or at the peak? The answer is we can't know for sure. Therefore, we need to find a trading strategy that allows us to benefit from continuous skyrocketing gains, while also handling the potential losses if the skyrocketing turns into a bubble. Obviously, simple stock trading cannot achieve this effect. We need to use options. Some might say, this is easy, I'll just buy call options. The cost is low and the leverage is high, allowing me to make a lot with a little. If it works out, I'll get rich overnight. If it doesn't, I won't be too heartbroken since the cost is low. In fact, many retail investors do trade skyrocketing stocks this way. It sounds perfect in theory, but in practice, there are many unexpected difficulties. Understanding these practical difficulties is crucial to building a proper option strategy. Let's take Tesla as an example. Suppose you had good foresight and saw the potential in Tesla at $100, so you bought a call option. Now, the stock price has risen to $150, and your call option price might have quintupled. What do you do next? Do you cash in your gains, fearing you might not keep your profits if there's a pullback? Suppose you sell the call, but then the stock price continues to surge. What do you do? Having tasted success once, you might feel you were too conservative the first time and didn't make enough, so you buy another call option. As the stock price continues to rise, you make more and more. But what do you do next? Some might say they would cash out, but then miss out on further gains and feel envious. Others might say they are bullish and continue adding positions. But when the stock reaches its peak, they would have the heaviest positions. A 50% drop from the peak could wipe out all their gains. In 2019, a Canadian investor entered Tesla with $80,000 in call options and made up to $400 million at its peak. However, as Tesla's stock price declined, he ultimately went bankrupt, losing everything. This is an extreme case but reflects the real experience of many retail investors using options to bet on rising stocks. While it's possible for some to profit from the ups and downs of stock prices, the undeniable fact is that most retail investors cannot handle such opportunities and end up losing all their gains in one risky trade. The ideal scenario of low-cost, high-leverage for skyrocketing stocks looks beautiful, but the real challenges faced in practice are far from simple. There are too many difficulties that call options alone can't address, which is why most retail investors, even when they correctly judge the opportunity, fail to make real profits. So how should we correctly operate? My strategy actually involves buying call options as well. Now, some of you might say, aren't you contradicting yourself? You just criticized buying call options, and now you're doing the same. Indeed, but my approach to buying call options is entirely different. Today, I want to introduce you to the proper use of the long call option strategy. I have seen many people scoff at the long call option strategy, thinking that using it means you're just naive. The problem doesn't lie in the long call option strategy itself, but in how it's used. Let's reflect on the retail investor's operations of buying call options I mentioned earlier. Do you know where the problem lies? The issue is that people constantly try to predict stock price movements, attempting to make money by buying low and selling high, which essentially follows the logic of stock trading. Here, trading options merely utilizes their high leverage to make a bit more money when the stock price rises. However, it's important to understand that stock price movements cannot be precisely predicted. The more you try to predict, the more you'll fall into psychological traps. The true value of options isn't in their high leverage, but in their ability to manage risk. This risk includes both downside and upside risks. Fortunately, while stock prices can't be predicted, risks can be. In fact, options were initially created to manage risks, although they were later misused by those who didn't understand them. Sadly, the true benefits of option haven't spread, but the wrong usage has become deeply ingrained. Today, our purpose in using the long call option is to manage upside risk. What is upside risk? It contrasts with downside risk, which is easier to understand. In a declining market, we're warned that the stock price might continue to fall. That's downside risk. Conversely, in a rising market, a company's stock price might unreasonably soar without any valuation correction. Even if you highly favor a company, watching its stock price rise daily without a good entry point can lead to missed gains, which can sometimes feel worse than losses. We've seen this many times with Tesla in 2021. If downside risk equates to the risk of loss, then upside risk is the risk of missing out. To manage upside risk, the long call option is indeed a good tool. First, it has a low cost, so the downside risk is limited. Second, it benefits more as the stock price continues to rise, meaning our gains accelerate if the stock price skyrockets. This means that the more the stock price rises, the better we manage the upside risk. You'll make more and more money. Using these two characteristics to manage upside risk leads to different practical operations from traditional methods, mainly in four areas. 1. Timing of opening positions. 2. Selection of strike price. 3. Selection of expiration date. And 4. Subsequent handling. These operations aren't complicated, so let's go through them one by one. Opening positions. Traditional methods focus on finding pullbacks or low prices to open positions. However, to manage upside risk, you should open positions as early as possible, because once a skyrocketing stock begins to soar, its upside risk is already in play. Waiting another day, regardless of price movements, doesn't change the risk and might even increase it. Therefore, dealing with it earlier brings more peace of mind. Selection of strike. Price. Traditional methods might prefer out-of-the-money options, which means the strike price is higher than the current stock price, because they're cheaper and offer higher leverage for amplifying gains. However, to manage upside risk, you should open at-the-money options, meaning the strike price is close to the current stock price, as they are best for managing risks. Selection of expiration date. Traditional methods might prefer very short-term options due to their lower costs and higher leverage. For upside risk management, I suggest beginners choose options expiring in more than 2 but less than 3 months. Long-term options are too expensive, increasing downside risk, while short-term options don't manage risks well. This balances cost and hedging effectiveness. For experienced traders familiar with options, 3-month to 1-year options might be better as they can be cheaper over longer periods, though handling them requires high expertise. Not recommended for beginners. Subsequent handling. This is the hardest part of the strategy and fundamentally different from traditional long call options. Traditional long call options aim to predict short-term stock price fluctuations, selling at peaks to make money. However, predicting these peaks is nearly impossible and can trap you psychologically. While predicting stock prices isn't feasible, predicting risks is. Let me share a real example from my experience with Tesla. After Tesla's earnings report, the stock price surged over 20%, and I opened a long call option. Analyzing the earnings report, I found the company's fundamentals confirmed a reversal, and macroeconomic conditions were favorable. This was the best environment for Tesla to be hyped, a phenomenon seen multiple times before. To manage this upside risk, I opened a long call option. Closing positions is much harder than opening. When should we close? I've held this position for over a month, during which the stock price soared and had significant pullbacks. Questions arose like, has this trade peaked? Or is this pullback the end of the rise? Frankly, I have no answers to these, and wouldn't close positions based on these price fluctuations. My purpose is to manage upside risk, so I close positions only when I believe the upside risk is mostly resolved. Is the risk resolved now? I don't think so. The fundamental reversal is confirmed, potential performance gains still exist, and macro uncertainties remain. Market trading sentiment is high. I can't predict if the stock will continue rising, but I believe the upside risk persists, so I retain this long call option. This is just my approach, and my judgment might not be correct. If you think the upside risk has ended, closing your position is also fine. Some may worry about missing price peaks by waiting until risks resolve. Indeed, My goal with long call options isn't to maximize profits in this phase, knowing that's impossible. My aim is to manage uncertain price fluctuations and maintain peace of mind amidst market hype. If it skyrockets without looking back, great, my call option manages upside risk. If it's just hype and prices fall back, I've hedged the risk and kept costs controllable. In practice, if holding a long-term call option like mine, I'd hold until upside risk resolves. The problem is the high cost of such options, around $5,000, with price fluctuations causing significant option price changes. Without enough experience, you might not withstand this volatility and get prematurely out. Beginners should start with 2 to 3 month options, lower costs, then roll over a month if upside risk persists, maintaining the same hedging effect until risk ends. This way monthly costs, i.e. downside risks, are smaller, easing the holding mindset. Avoid getting fixated on rolling over. If prices stagnate, it likely signals resolved upside risk and quick loss cutting is needed. We've now covered all the operations. You'll notice the core difference lies in predicting stock price movements versus assessing risks. The former is challenging, while the latter, although not easy, is analyzable through traditional fundamental analysis. While stock price analysis has methods, most can't be proven right or wrong. I prefer fundamental analysis because it can be verified and replicated. Combining options trading with fundamental analysis is, in my view, the best approach for peace of mind in investing. I need to add some final notes to this operation. Although the long call option strategy can address upside risks in skyrocketing stocks, it is still a high leverage and high risk operation. If the stock price doesn't move as expected, there's a possibility of losing all your capital. Therefore, you should never take overly large positions. I emphasized the importance of maximum position size earlier, and it must be reiterated here. We've discussed the use of long call options, but personally, I prefer opening positions with a small amount of the underlying stock combined with a small amount of long call options. The small position is to manage risks. The underlying stock leaves room for long-term investment, and the long call option handles short-term upside risks. If you're not familiar with options trading, opening a position with a small amount of the underlying stock alone can fully apply all the investment logic we've discussed. That concludes today's video. If you like my video, don't forget to like, subscribe, and share it. Thank you all.